We're going to go here. A recent episode of What Bitcoin Did with Dr. Jeff Ross and Danny Knowles. Shout out to those guys.
Okay, let's do this chart. So this is the S&P priced in gold.
S&P 500 price in gold. It's a 100-year chart. Goes back to, I think this chart is back to about 1924. I cannot stop thinking about this chart. And, I'm a hedge fund manager. We had a great year last year. It was the, and not to flex, but it was the top performing multi-strategy hedge fund in the world last year.
Let's go, Jeff.
According to Barclay Hedge database, we returned 199% after fees.
Damn.
So I only say that not to flex, but to just give credence. Like I'm a pretty good investor.
I'll flex for you, Jeff. You know what's going on. That's fucking incredible.
I'm not a terrible investor, and so I only say that just for you guys to take a little bit of credence into what I'm saying and to actually consider this.
Can I just quickly explain this for anyone who's listening on audio and can't see the chart? So this is the S&P priced in gold. We have 4 highs, which is September 1929, just before the Great Depression, October 1967, which is just before everything got super inflationary. Is that right?
Yep.
Then 99 .com boom, and then you also have Jan 22 in here.
Yep.
Okay, so run us through it.
Okay, so the way I explain it initially to people is, if you were given the choice, if you understand financial history, and most people who are in Bitcoin or in the investment world do, if I asked you if it was the year 1929 or 1969 or 1999, and you could invest in either US stocks for the next 10 years or gold for the next 10 years, what would you do?
Easy answer.
Easy answer, right? Everybody would say that. And so I think, based on this chart, but not just based on the chart, I think when you look at everything that's happening in the whole geopolitical sphere, this is clearly what's happening. There are 10 to 20 year segments or even longer where the world.
So that's enough of that for now. If you're interested in that specific conversation, do go and look it up. It's absolutely awesome. As you hear, Jeff he's not fucking around. His hedge fund did 199% last year. That's an incredible return. So it's not just someone with deep expertise, but also it's the results to back it up. And what's he looking at? And this is what I love as an investor. I go and learn about what people who have clearly created themselves a strategy that works. Success leaves clues is a phrase that I love. What are they looking at? And so my analysis on this chart is quite straightforward. It's like, holy shit, not just the boom and bust of the last 100 years, it's very obvious, but where's the actual value growth? And that is why money printing is so nefarious. Everyone thinks they're getting rich because the dollar figure is going up. But the reality is purchasing power is barely changing. So the difference between the bull market top of 1929 and 2022 are very, very similar. If you look at the chart, what's the difference? It's barely moved. And that's because this is the S&P index being priced in gold. And it happens all the time. Go and follow what the local housing market you live in priced in gold. It won't have changed all that much. Indeed, the amount that it costs for a fine tailored suit from Savile Row today is roughly the same amount as what a nice item of clothing for a gentleman of the Roman era would pay in gold. The point is, value can be seen differently when measured differently. And that's what Bitcoin does. It starts to measure things differently, as does gold. And so, awesome moment for me really was that idea of, okay, well, hang on. What does it mean if the denominator of all the stuff I'm looking at is actually disintegrating in value and the assets themselves aren't getting more and more and more expensive? The money is being debased, and therefore you can buy less stuff with it. And this is a 100-year time frame and clearly shows that the S&P, you can buy as much of it today with gold as you could in 1929. What the hell? So very, very insightful. Point here is he's looking at cycles and he's trying to think about, okay, what's going to happen over the next 10 years? Where is liquidity going to come from? How's that going to change things? Go and listen to the whole conversation. I absolutely loved it.